Well, good to see you all. I've been doing this investing in business thing for quite a spell now, going on over 70 years if you count back to when I bought my first stock at age 11. My dad, he ran a stock brokerage during the Depression, and I was just a kid delivering newspapers in Omaha, saving every penny. I filed my first tax return at 13, deducting $25 for my bicycle. The lessons start early, you see, and sometimes they come with a hefty price tag. I remember back in the early 1960s, I made one of my biggest mistakes, one that still teaches me every time I think about it. It was with Berkshire Hathaway itself, a New England textile company. I started buying shares in 1962. The company was struggling, but the stock was cheap, was trading at around $7 or $8 a share. And the company had some working capital, some cash, some plant and equipment. It seemed like a classic Ben Graham cigar butt situation. A few puffs left, at a deep discount to liquidation value. The management, a fellow named Seabury Stanton, had a habit of buying back shares when the company did poorly, which was often. So in 1964, Seabury came to me and offered to buy my shares back at $12 a share. We had a handshake deal. I went out and bought more shares, thinking I had an arbitration profit locked in. But then the formal tender offer came in at 11 3/8. What a bonehead move on his part, and on mine for trusting a verbal agreement implicitly in a competitive situation. I was dumb enough to get mad. That little insult of an eighth of a dollar difference, it set me off. My emotions took over, and I decided I'll show him. Instead of selling my shares and making a tidy profit, I started buying more aggressively. I used my partnership money, buying control of the company. Also, I could fire Seabury, and I did. But getting rid of him didn't make the underlying business any better. I ended up pouring good money after Dad into a dying textile mill for years, trying to fix something that was fundamentally unfixable. It was a $20 decision, a small matter of principle that cost me literally billions of dollars over time. If I hadn't bought Berkshire, if I'd just stuck to my original plan and sold the shares, think of all the capital I could have deployed into truly wonderful businesses much earlier. That decision alone, driven by a bruised ego, was probably a $200 billion mistake in terms of opportunity cost. What a fool I was. Here's what I learned from that mistake, and it's a lesson Charlie Munger has drilled into me over and over again, though I was a slow learner on this particular point. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The textile business was a terrible business. It was capital intensive, required constant reinvestment just to stand still, faced intense competition from low-wage countries, and had no pricing power. There was no moat, no durable competitive advantage that protected it from rivals. Ben Graham taught me to buy cheap, and that's a powerful tool, a critical concept of margin of safety. But Charlie showed me that if you bought cheap businesses that were still bad businesses, you were just buying cheap misery. Investing is a lot like baseball, you don't have to swing at every pitch. In fact, the best pitches are the ones right down the middle, the ones you understand, the ones where you can hit a home run. The textile business was an outside pitch, barely in the strike zone, and I swung anyway, all because of a little pride. You don't need to be a genius to understand this. You just need patience and the discipline to stick to what you understand and ignore everything else. My dad taught me the importance of integrity, but I had to learn the hard way. Sometimes business decisions require you to detach from personal feelings, even when you feel wronged. The market doesn't care about your feelings. It cares about cash flow and intrinsic value. Intrinsic value is simply the present value of all the cash that a business can generate in the future. If a business can't reliably generate increasing cash flow, or if it requires constant, huge capital outlays just to maintain its position, then its intrinsic value is probably low, no matter how cheap the stock looks. This reminds me of another principle, one that applies whether you're buying a business or just a stock. Always think of it as buying a piece of a business. When you buy a farm, you think about its productive capacity, what it can yield, how much corn or wheat it can grow. You don't buy it just because it's on sale for less than what someone else paid for a similar farm last year. You buy it for what it can do for you. A stock certificate is no different. It's just a piece of paper representing ownership in a business. Focus on the business. Take your Cease Candies, for example. We bought Cease in 1972 for $25 million. It was earning about $4 million pre-tax then. Charlie and I were sitting in the office one day, and he reminded me about the experience. I was hesitant, thought it was too expensive, but Charlie pointed out the wonderful characteristics: brand loyalty, pricing power, a simple business model, and a strong management team. Over the years, that business has generated well over $2 billion in pre-tax profits for Berkshire Hathaway without requiring significant capital to grow. We could raise prices a little bit each year, and people still bought Cease because it was part of their family tradition, something special. That's a wonderful business at a fair price. Compare that to the textile mills at Berkshire. For decades, we poured money into those mills, hoping to turn them around. We spent hundreds of millions trying to make a commodity business into something it wasn't. We invested in new machinery, laid off workers, tried every trick in the book, but the nature of the industry meant we were constantly fighting against the tide. It was like trying to swim upstream against a powerful current. With Cease, we just floated downstream and the profits kept flowing in. That difference, that understanding of a durable competitive advantage, a moat, is crucial. Or think about Coca-Cola. When we started buying Coca-Cola stock in 1988, we paid about $1 billion. At the time, they were selling maybe 7 billion cases of soda worldwide. Today, it's closer to 20 billion cases, and the brand is stronger than ever. It's a simple product, universally loved, with incredible distribution and brand recognition. People want that little moment of refreshment, and they'll pay for it. That's a business you can, a business with a powerful, enduring moat. We held that stock, and it turned into many, many billions of dollars for Berkshire because we understood the business and its future prospects, not because we were trying to arbitrage a small difference in price. I've made other mistakes, of course. I bought Dexter Shoe in 1993, paying $433 million using Berkshire Hathaway stock as payment, which was a huge mistake on its own. It was a die-in business, much like the textiles, and I didn't see it coming. I totally misjudged the competitive landscape. That was a $500 million mistake, a complete disaster, and it essentially gave away Berkshire stock that's now worth many billions. What a painful lesson in understanding competitive advantage. If a business doesn't have a moat, a sustainable way to keep competitors at bay, then its profits will eventually be competed away. It's that simple. If you're a young investor today, sitting there with some savings, wondering where to put your money, the first thing I'd tell you is this: learn to think like an owner. Don't think of yourself as a stock speculator, constantly checking quotes. Think of yourself as buying a small piece of a productive asset and only buy what you understand. My dad always said, never invest in a business you can't understand. If you can't explain what the business does, how it makes money, and why it will continue to make money in 5 or 10 years, then don't buy it. It's not about IQ. I've seen people with 60 IQs fail spectacularly in investing because they try to do complicated things in areas they don't understand. What I'd tell my younger self, having seen all I've seen, is to cultivate temperament. The market is there to serve you, not instruct you. Mr. Market, as Ben Graham so eloquently described, is a manic depressive. Some days he's ecstatic and offers to buy your shares at outrageous prices. Other days he's depressed and offers to sell you shares at ridiculously low prices. Your job is to ignore his mood swings and only transact when it makes sense for you based on your own assessment of intrinsic value. You don't need to do extraordinary things to get extraordinary results. You just need to do ordinary things extraordinarily consistent. People think you need fancy maths, sophisticated computer models, or inside information to succeed in investing. That's hogwash. You need a few simple concepts, the right temperament, and the ability to ignore the noise. Charlie always says, it's not that hard, it's just uncommon. It's uncommon because human nature pushes us towards following the crowd, towards chasing hot stocks, towards feeling smart by doing complicated things. But the truth is, the simpler you keep it, the better. Read annual reports, understand the business, and be patient. That's the formula. This applies to any business, not just investing in stocks. Whether you're starting a lemonade stand or running a multi-billion-dollar conglomerate, what really matters in business is the underlying economics of the enterprise, how efficiently it can deploy capital, and the quality of its management. We want businesses with wide moats. Think of a medieval castle with a big, deep moat around it, making it hard for invaders to get in. That moat can be a powerful brand, a unique technology, a cost advantage, or even just habit. See's Candies has a moat of tradition and taste. Tyco has a cost advantage and brand. Apple has a powerful ecosystem and brand loyalty. And it's not just the moat, but also the folks running the show. We look for honest, able, and energetic managers. If you have an honest and able manager who's energetic, that's great. If they're honest and able but lazy, that's okay. They won't do too much damage. But if they're not honest, well, that's a whole different ballgame. We've been lucky to find some truly remarkable managers at Berkshire, like Ajit Jain at our insurance operations, or Greg Abel overseeing our non-insurance businesses. They run their businesses as if they own them, which is exactly what we want. The biggest lesson about human nature, I think, is that people are driven by fear and greed. These two emotions often drive the market to extremes, creating opportunities for the patient and rational investor. Be fearful when others are greedy, and greedy when others are fearful. It's easier said than done, of course, when the headlines are screaming doom or euphoria, but it's a timeless principle. And remember, our favorite holding period is forever if it's a good business with good management. But that's not the only lesson I learned the hard way about human psychology and the perils of ignoring the obvious. This reminds me of another time, much later in my career, when I let my initial enthusiasm for a company blind me to its changing fundamentals. It was an example of how a once great business can become a trap if you aren't vigilant, and how even an old dog like me can make new mistakes. You know, back in 2007, when the financial crisis was just starting to brew, I made a mistake with Tesco, the British grocery chain. We had a pretty good position, about 5% of the company, and I liked the business. It was a good company, seemed well run, and I had a decent understanding of the grocery business. But then as the years went on, the company started doing some things that didn't quite sit right with me. They started building out these huge superstores, moving into different lines of business, expanding overseas in ways that didn't feel as disciplined as their core operation. I ignored a lot of the warning signs. The competition was intensifying, and Tesco started losing market share. The pricing power began to erode, and their new ventures weren't performing as well as hoped. I kept holding on, thinking it would turn around, that the good old management would fix it. It was a classic case of anchoring to my initial favorable opinion and failing to adapt to new information. I even added to our position in 2012. What a bonehead move that was. Eventually, in 2013 and 2014, the situation became undeniable. The company was struggling badly, and there were accounting issues that came to light. It became clear that the business had fundamentally deteriorated. We sold out of Tesco at a significant loss. I lost several $100 million on that investment. It was a painful reminder that even if you start with a good company, you have to continually reevaluate its competitive position and management's capital allocation decisions. The world changes, and businesses can lose their moat. The lesson there was that even a solid, recognizable brand can lose its way if management gets distracted or loses discipline. The idea that a big, strong company can't fail is a dangerous one. Hubris, both in management and in an investor, can be a killer. You have to be willing to admit when you're wrong and cut your losses, even if it means acknowledging a mistake publicly, which I did in my annual letter. It's smarts, but it's part of the game. Another time, early in my partnership days, back in the 1960s. I made a mistake by investing in a company called American Express. Now, it eventually became a huge win for us, but it started with a scare. In 1963, there was the salad oil scandal. A guy named Tino de Urales had defaulted on huge loans collateralized by non-existent salad oil stored in tanks. American Express, through its field warehousing subsidiary, had vouched for the oil. Suddenly their stock plummeted. Everyone thought American Express was going to go bankrupt. The market panicked. Their stock dropped from $60 to $35 in just a few days. Now, Charlie and I, we saw an opportunity. We didn't know anything about salad oil, but we knew a lot about American Express's core business, credit cards, traveler's checks, and banking. We spent weeks in New York visiting restaurants and stores, asking people if they'd still use their American Express card, if they still trusted their traveler's checks. And everywhere we went, people said, of course, the brand, the trust was intact. We realized that the market was confusing a temporary, although significant financial problem with permanent damage to the brand and its earning power. We put a huge percentage of our partnership's capital, I mean, a really huge percentage, into American Express stock. I couldn't sleep some nights thinking about the risk, but the conviction about the underlying business and the massive discount to its true value outweighed the fear. It worked out wonderfully, and we made a lot of money. It taught me the power of focusing on the underlying business and its customer perception, especially when others are in a state of panic. Be greedy when others are fearful. It also underscored Ben Graham's concept of a margin of safety. We were buying a dollar for 40 cents, not because the business was fundamentally flawed, but because of a specific non-recurring problem that frightened everyone else. You want to buy stocks like you're buying a $100 bill for $50. You don't need to do fancy math to understand that. You just need to have the discipline to wait for those fat pitches, those obvious opportunities. Now, about compounding. It's been called the eighth wonder of the world, and it really is. My whole life has been about letting money compound over time. I delivered newspapers as a kid, started various small businesses, saved every penny. I bought my first stock, City Service Preferred, at age 11 for $38 a share. It dropped to $27, then went back up to $40. I sold it, made a few bucks, but then it shot up to $200. I learned about patience and the power of letting things run. If I had held on to every good investment, I'd be even richer, if you can believe that. Compound interest truly is magical. Even small amounts, invested wisely and left alone for decades, can grow into fortunes. This means starting early, even with a little bit of money, is a huge advantage. And it means avoiding unnecessary transaction costs and taxes. Every time you trade, you pay someone, and you pay the government. You chip away at the compounding machine. Our philosophy at Berkshire is our favorite holding period is forever. That's how compounding works. It's magic. It's not about being super active in the market. I spend 80% of my day reading annual reports, newspapers, industry journals. I read hundreds of annual reports every year. I'm just looking for ideas, looking for businesses I can understand, businesses with durable competitive advantages run by honest and capable managers. And then I wait. Most of the time I'm doing nothing. It's like waiting for the perfect pitch in baseball. You wait and wait, and then when it comes, you swing with all your might. Especially that with Apple more recently. For years, I avoided tech companies because I said I didn't understand them. I'd stick to my circle of competence. But with Apple, it became clear to me that it's not just a tech company, it's a consumer products company with an incredibly sticky ecosystem and brand loyalty. People love their iPhones. They're willing to pay a premium and they don't switch. That's a powerful moat. Charlie and I started building our position, and it became one of our largest holdings demonstrating that my circle of competence can expand slowly, carefully, with enough study. The key is that you have to understand the why. Why do people buy Apple products? Why do they choose Coca-Cola? Why do they trust American Express? It's not about the latest gadget or the quarterly earnings report. It's about the fundamental human behavior and how a business taps into it in a sustainable way. That's where the value lies. Now, a word about debt. I've never borrowed significant money personally, and I don't like companies that carry a lot of debt unless it's very carefully managed and for a specific intelligent purpose. Debt can accelerate returns when things are good, but it can utterly destroy you when things go bad. Even if you're a genius, a little bit of bad luck with a lot of debt can wipe you out. Rule number one, never lose money. Rule number two, never forget rule number one. And debt is one of the fastest ways to break rule number one. Think about what happened in 2008. The financial world was swimming in debt. People and institutions taking on far too much risk. When the tide went out, we saw who was swimming naked. At Berkshire, we always keep a massive amount of cash on hand. People often criticize us for it, saying we're missing out on opportunities, but that cash provides optionality and a margin of safety during times of panic. It lets us be greedy when others are fearful, just like with American Express during the salad oil crisis, or investments in Goldman Sachs and GE during the depths of the two. At Berkshire, we've always emphasized building a fortress balance sheet. We avoid complexity. We avoid things we don't understand. We try to buy businesses so wonderful that an idiot could run them, because eventually one will, and we want them to generate lots of cash, which we can then reinvest in other wonderful businesses or hold for the next big opportunity. It's really quite simple when you boil it down, but it requires discipline to stick to it when everyone else is doing something different. Every year we have our annual meeting in Omaha. 40,000 people come from all over the world, and it's quite a spectacle. A shareholder once asked me, "What's the best investment you ever made?" And my answer is always the same: investing in myself, reading, learning, improving my skills, understanding human nature. It's the most valuable asset you have. Spend your time and energy learning, absorbing, understanding. It compounds faster than anything else. So I live in the house I bought in 1958 for $31,500. I drive myself to the office every day, the same office I've had for decades. My diet, cherry Coke, See's Peanut, Brittle, Dairy Queen, McDonald's. People laugh, but I'm a happy guy. Simplicity works in life, and it works in investing. Don't complicate things unnecessarily. The world is complex enough without you making your investing strategy complex too. Parry as you break. After more than 80 years of doing this, here's what I know for certain. Investing success isn't about intelligence, but about temperament. It's about patience, discipline, and the ability to control your emotions, especially fear and greed. It's about understanding what you own, treating stocks as fractional ownership in businesses, and letting the power of compounding do its work over very long periods. I'm 94 now, and if I could tell young investors one thing, one single piece of advice, it would be this: find a simple strategy that makes sense to you, that you can stick with through thick and thin, and then just do nothing for long periods. Don't check the market every day. Don't listen to all the pundits. Read, learn, and focus on the fundamentals of the businesses you own or want to own. The biggest returns often come from simply doing nothing.
I'd never bet against America. This country has an incredible capacity for innovation, for adaptation, for growth. Despite all the challenges we face, the long-term trajectory is up. So invest in America, invest in good businesses, and let the future take care of itself. You don't need to be brilliant. You don't need inside information, and you certainly don't need to listen to me every day. Just be patient, be disciplined, and understand what you own. As my partner Charlie always says, all I want to know is where I'm going to die, so I'll never go there. In investing, know where the risks are, avoid them, and the rewards will take care of themselves. That's the truth of it.